from this reading perspective. Yeah. So this reading and this chapter basically focuses on where is time value of money used in finance. So it could be used in places as diverse as valuation to pricing, to probably understanding whether a project should be taken up or not, which is basically part of capital budgeting. So it can be used in corporate finance, it can be used in banking, it can be used in derivatives, it can be used in equities, fixed income. So time value of money is very critical in finance. It's the most important quant concepts which are used, and those have widespread applications throughout, right? So this reading is going to focus on the same. Just one second. Yeah. So very briefly, there are two important aspects of money. One is called as present value and the other is called as future value. Just one second. Yeah. So there is there are two concepts, right? So most important thing which we have done in reading one is money today is not worth the same as money tomorrow, right? And the reason behind that is there is inflation. There is also the fact that you can invest today money in various investment scenarios or horizons where you can earn returns, be it a risk-free return or a risky return. And hence money worth today will not be the same as money worth tomorrow, right? So money worth today is more than money worth tomorrow because you can invest the money today in different kinds of investment opportunities. And hence, a lot of times when we have to, deal with valuation related concepts or project related cash flows, it's very important for us to bring everything to parity today, which means we have futuristic cash flows. We would want to equate them to the what are the values of those cash flows today. So hence the concept of present value. So everything which is in the future, either estimated or known or deterministic, needs to be discounted back to the present. And hence future value are all estimated cash flows in the future, all futuristic cash flows. And their equivalent values today are called as present values. Yeah. So how to convert present into future value? This is a simple formula which helps us do that. Future value is equal to present value into 1 plus r raised to t. And obviously this involves compounding. And this also assumes that every year we earn a return of r. So suppose we are investing for 3 years and we start with PV as a starting amount. Can I say at the end of the first year, this amount will be worth PV into 1 plus r. At the end of the second year, it will be worth slightly more, PV into 1 plus r whole square. In the third year, it will be worth PV into 1 plus r whole cube, right? And we can generalize this and say that across T years, this is what you will earn. Now, one thing which we have to take care of in CFA is compounding and frequency of compounding as well. So that's something which is going to be important to look at. So FV is equal to PV into 1 plus R raised to T, right? Now, as soon as I tell you this is annualized on basis, this is annualized basis, right? So what if I tell you that there is more frequency of compounding every year? Suppose there is semi-annual, there's quarterly, or there's monthly, right? For instance, when we talk about EMIs, we're talking about loans, right? Most of these loans are based on EMIs, which are basically assuming monthly compounding. So annualized basis, very few places are annualized. Most of the things which we see in finance, the real world applications, are all involving frequency of compounding. Yeah. Now, when I talk about frequency of compounding, the most basic frequency of compounding is breaking up 1 year into two parts, which is 6 months, 6 months period. So this is basically called as semi-annual, where frequency F of compounding is 2 years. Yeah. Can I term this as semi-annual? In this case, suppose R is the annualized return, which you are planning to earn per period, per 1 year period. In 6 months, the rate of return will be R by 2. So whatever is your annualized return, that has to be multiplied or rather divided by the frequency. So when it's semi-annual, clearly the rate, suppose R is equal to 10%, yeah? So can I say you will end up earning 5% every 6 months? If 10% is the rate for 1 year, then 5% is the rate for 6 months. And hence, here the future value formula will look like this. So can I write 1.05 into 1.05 is the future value. So, and into obviously your present value. You start with PV. At the end of the first year, you have earned 1.05 times PV, and at the end of the second year, you have earned 1.05 square times PV. So can I say that in a 1 year's period, you've due to semi-annual compounding, you've compounded this, and there are two periods of compounding because there are two 6 month periods in 1 year, and hence the formula looks like this. I can rewrite this as 1.05 square, and I can also rewrite this as PV into 1 plus 10% by 2 raised to 1 into 2. And I can generalize this now as PV into 1 plus R by 2 raised to 2 times T, where T is number of years. So in this formula, the first formula that you'll see on the top, that is number of years. R is the annualized rate per annum. So as soon as I have frequency of compounding of say semi-annual where F is equal to 2, my rate becomes half and my time, which is 1 year, can I say raises to 2 because there are two 6 month periods. Similarly, let's take quarterly compounding, which means
Sir,
every
just a
quarter there
small
is
doubt.
compounding. Yes, yes, please.
Sir, if I'm assuming that I have a 10% annual rate of return, and
Yeah.
when I am assuming it to be semi-annual, I'll just divide it by 2, but these values will give me different returns overall. Like 1.05 ka square is not equal to 1.1.
Correct. We don't have to. So equivalent or effective rate of return is different from what you earn. So that's what I'm trying to say. As soon as you have compounding, okay. So that's a good question. So what you're saying is, okay, if I assume 10%, right, and if I have F equal to 1, right, can I say my effective rate of return is what? 10% only, right?
Yeah.
But as soon as I say F is equal to 2, which means you're dividing it into two periods, 6 months each, and you're saying we are earning 5% every month, right? So then your effective rate of return becomes more 1.05 square minus 1. So I think this will be 10.25%. Similarly, if we do quarterly compounding, the effective rate of return will be even more because then the base period, which is 1 quarter, the return is 2.5%, notional return. So it will be 1.025 raised to 4 minus 1 will be effective return. That will be more than what you're seeing here, which also means that as your compounding increases or frequency of compounding increases, my effective rate of return, which I'm earning, also increases. And that's how banks make money. For instance, bank will tell you that 10% is your interest rate. Okay, that is usually annualized interest rate. But
Yeah.
effectively, what they are charging is much more than that because Imagine what a bank does. Bank is even compounding even more than this. Bank is working on monthly compounding concepts, which means entire year divided into 1 month period. And if suppose 10% is your loan rate, yeah, annual loan rate. So can I say the monthly rate will be 10% by 2? So the compounded rate actually will be, or the effective rate which you are paying will be 1 plus 10% by 12 raised to 12 minus 1. So this is your monthly rate, and these are your number of periods or number of months in a year. So effective annual rate becomes much more. Yeah, we can actually calculate this. Can you shut this? Switch on the AC. So let's see how much it is. It's 1 plus 10% by 12, and the whole thing raised to 12 minus 1, right? So effectively, can I say it's around 10.47%? So I can actually create a small table where this is the frequency of compounding 2, 3, 4. We can have 12. I can actually link the effective rate to the frequency. So if I have semi-annual compounding, the effective rate, as you can see, becomes 10.24%. This is the column of effective rate. The formula which I have used is this. So effective rate for semi-annual compounding is 10.25. But as soon as I increase my compounding frequency, the rate is much more. Yeah. So if the bank tells you that 10% is your rate of interest, annual rate of interest, that is called as APR, annualized percentage rate. Yeah. That is only a notional rate. The actual rate which you earn or which you pay actually is 10.47 on the loan, which is the effective rate. So keeping the notional rate same, if you increase the frequency of compounding, your effective rate is going to increase. And that's what banks do in terms of their liability books or asset books, because when they give loans, it's an asset for the bank. Any question? Sarthak, is that clear?
Yes, sir.
Okay. So as soon as we increase the frequency of compounding, as we have seen here, the rate increases, right? The effective rate. And that is what we've seen. So just going back to the previous case, in quarterly compounding, I will divide the entire 1 year into 4 quarters. In each quarter, R by 4 will be earned, and hence the future value, can I say, will be nothing but present value into 1 plus 10% by 4 raised to 4. So this is the quarterly rate, notional rate, and raised to 4 is because there are 4 quarters in 1 year. And I can generalize this if I have T years and R is the APR or annualized percentage rate, then FV can be written as PV into 1 plus R by 4 raised to 4T. So as you can see, when there is frequency of compounding, you need to divide your rate by f, and you need to also increase the number of years by f. So I can generalize this formula and I can write, in the case of compounding, fv compounded will become pv into 1 plus r by f raised to t f. This is the most important formula which we will be using throughout CFA. Any questions on this?
No, sir.
Okay. Yash, all good?
Yes, sir.
Okay. All right. And in Excel, we have just completed how to look at the effective rates. Yeah. So let's continue. Now, applications of whatever we've looked at, right? So we have looked at these two important formula. One is annualized version of the formula, and the other is the compounded version of the formula with frequency of compounding greater than equal to 2, which means we are splitting a year at least into semi-annual buckets, at least. Yeah, so these are two important formulae. Now let's look at where are these applied. So the first application is in terms of valuing a zero coupon bond. A zero coupon bond is a very simple fixed income instrument, right? Now, when I look at fixed income instruments or bonds, two types of bonds. Yeah. One are uh, based on whether they bear coupons or not. Can I say each bond is going to bear some coupon or may not bear a coupon? So, no coupons and coupons. The bonds which do not bear any coupons are called as zero coupon bonds. Zero coupon bonds. The cash flow diagram will look like this. So initially at zero, you're going to invest money, which is P0, which is the price of a zero coupon bond. And at maturity, you will receive back your par value on the bond, which is 100 usually. So this is the cash flow diagram for a zero coupon bond, which looks like this. For a coupon bearing bond, the cash flow diagram will be at zero. You will make some investment into the coupon bearing bond. That's you pay the price of a coupon bearing bond, whatever that price is. And every frequency of compounding, suppose frequency of compounding here is annualized. So every year you are going to receive some coupons. So CC are the absolute coupons, and this will keep going on till time T, which is the maturity of the bond. And at time T, you will receive coupon as well as the par value. So 100 is the par value. So this is the basic structure of any fixed income instrument. So here we have divided that into two types based on whether they bear coupons or not. One is something called as zero coupon bonds, which do not bear coupons, and the others are called as coupon bearing bonds. Yeah. So the first application is towards valuing zero coupon bonds. So zero coupon bonds, as we had looked at, there is the price to be paid today and the par value ultimately. So par value is always say 100. So how to find the price of the bond today is using our simple concept, right? So we've just learned future value is equal to PV into 1 plus R raised to T. So how to find the present value of the bond today? You know that future value is par value. It could be 100. In this example, the face value or the par value is 1,000. So suppose $1,000 is what you will receive at the end of year 15 because this ZCB matures in 15 years from today. It's also given that yield to maturity or the rate on the bond is 4%. And they're asking what is the bond's price today. So this is the question or the scenario. So we know the future value. We know the rate, which is 4%. So that also becomes your discounting rate. We know the period, which is 15 years. And we are asked what is present value. Right. So I can also rewrite this as PV is equal to FV divided by 1 plus R raised to T. Here we are obviously assuming annualized compounding is assumed here. So the frequency of compounding here is 1. Unless mentioned, we will always assume frequency of compounding is 1 on CFA. Yeah. So if you're using the calculator, these are the keys which you need to press. You need to put N as 15. This is the financial calculator. I by Y as 4, PMT as 0. PMT means constant payments. So here, since there are no coupons, PMT becomes 0. PMT is basically constant cash flows or any annuity stream. So there is no constant cash flow here because coupon, it's a zero coupon bond. So no constant cash flows every frequency of compounding. So PMT is 0. And if you key all of this, you can find the future value. Sorry, the future value is 1,000. And if you key all of this and compute PV, this is how you can find the PV on a financial calculator. Any questions?
No,
No,
sir.
sir.
Okay. Also, cash outflows will be regarded as negative values. Cash inflows will be regarded as positive values. So since future values is being received, that is treated as a positive cash flow. Hence, I'm putting a plus 1,000 here. And PV will be minus. This can also be done on Excel. I'll show you how this will be done on Excel. So the formula that we have is, so can I say I have FE as 1,000? All the assumptions I'm going to write here. R as 4%, which is your YTM, and time to maturity as 15. Now the question is, what is PV? So on Excel, how do you do it? So this is from real life perspective. So you take future value and you can divide by 1 plus rate and you can raise it to time. This is one way of doing it. So you are getting an answer of 555. So the price of the zero coupon bond today is 555.26. So this is using the simple foundational formula. We can also use the PV formula of Excel in which you supply the rate, you supply the number of periods. PMT, as we saw, is zero. There are no constant cash flows or coupon is zero. Future value is 1,000. And in Excel, there's a type argument towards the end. Are the cash flows end of the period or beginning of the period? Generally, the cash flows are end of the period. However, when you take a loan from the bank and you pay EMIs, EMIs are generally paid at the start of the period. Okay. Any which ways, you are getting the same answer, but in a negative value because Excel again, if you provide a positive future value, it will throw up a negative present value, obviously. So you can just put a minus in front and you get the same output. So two different formulae in Excel to do the same. One is using the foundational formula, which is the formula itself, and the second is using the PV function of Excel. Same like PV, if PV is known and FE is not known, in Excel again you have the FE formula through which you can find the future value. It works the same way as PV. So here, can I say there was annual compounding? What if I tell you, give you same problem and I ask you what is the value of the zero coupon bond if my frequency of compounding is quarterly? So what changes we need to do here? We will take the future value as is, but we will divide.
Aditya sir left his battery on.
Some
Yeah, sorry, you lost connection. So we have, suppose we have frequency of compounding is quarterly. Yeah, you all can see my screen, right? And you hear me.
yes, sir.
Okay, so now future value is not changing, but your rate and your time will have to be adjusted. So rate will have to be divided by 4 and time, which is in years, will have to be your time in years, you will have to multiply by 4 to give you number of quarters. So your base rate is in terms of quarterly rate. So your number of periods also has to be in terms of number of quarters because your basic unit becomes 1 quarter. And the present value is falling below 555. So obviously, what we are learning here is, um, let's go back to the slide. So what we have seen here or what we are learning here is that as soon as I say that I keep FV constant, okay, and I keep increasing the frequency of compounding, then can I say present value will fall? That's what we're seeing here, right? So for instance, this is my present value. In the case of annualized compounding is 555. As soon as I say let's do frequency of compounding is quarterly, the present value is falling below the annual PV. So quarterly PV is falling below the annual PV. And the reason is because your denominator will fall more and hence your answer will be even lesser. This is the basic formula which we have used. Future value is present value into 1 plus rate by F into FT. Yeah. So when I keep FV constant, basically I'm trying to use this formula, which is PV is equal to FV divided by 1 plus R by F raised to FT. Now, as soon as F increases, the denominator increases and this does not change. So your PV will fall. So that's how we get this relationship. On the flip side, if I keep PV constant, then if I increase my frequency of compounding, then FV will increase. And that's because we're using this version of the formula. PV is equal to FV is equal to PV into 1 plus R by F raised to FT. So if I'm increasing F, this term is increasing. And when I multiply with constant PV, your FV also will increase. So that's the relationship between PV, FV. If we keep one constant, what will be the impact on the other if frequency of compounding increases? So this is the interrelationship with respect to this same formula. Yeah. Any questions?
No, sir.
No, sir.
Okay. So this is quarterly compounding using the formula itself. And we can also do it with the formula, which is PV formula. So I can use the same PV formula. The rate which I will apply will be 4% divided by 4. Number of periods I will supply will be number of years into 4. PMT is 0 and future value will be 1000. So as you can see, same end result. If you want a positive value, just put a minus in front and we get the same output. Yeah. Okay, let's move on. The next thing is, what if you have negative yields? What will happen? What is negative yield? What will it mean?
Basically, you paid more for the bond right now than you will get in the future.
And why will yields turn negative in the first place?
Let's say there is some
Is it a
2008 like
practical concept?
crisis. There's some crisis or something like that.
Okay. Okay. Practically, in Japan, and also for years in Japan, the yields were negative for a lot of years. In Eurozone, the yields turned negative for some period. This happened when the base rate was close to zero. In COVID, if you remember, there were several rate cuts by central banks to boost the economies. And in some regions like EU, Japan, the yields were negative. Okay, which means you're actually earning negative return, which means what? Which means to make an FD, you're paying money to make an FD to keep your money safe. That is what it means, right?
Yes, sir.
So today you will pay more, and in the future you'll earn less, right? For instance, in this example, we are using the same example as before, but what if the yield to maturity is 0.5%? Then what is the price? Formula remains the same. Okay, so instead of 4%, we are putting minus 0.5%. But the implication is that the bond price becomes greater, right? Today, versus the future value. And such kind of a bond is, we say that the bond is trading at a premium over the face value. So whenever the price, so let's write this down. Whenever the price on a bond, so when yields are positive, okay, can I say present value will be less than the future value? Yes or no? Yields positive. I'm only talking about this formula, which is FE is equal to PV into 1 plus R by F raised to FT. Yeah. So when I talk about the perspective of this formula, when rate is positive, PV is less than FE. But when rate is negative, can I say PV will be greater than FE? So in terms of this zero coupon bond pricing, this bond, when the rate is positive, where actually, in most real cases, rate will be positive. So your PV or the investment value is less, you'll earn more in the future, which is why someone would invest in such kind of a bond. So hence, can I say, since PV is less than FE, this bond trades at a discount over the future value, which is the par value of 1,000 or 100. In the other case, when the rates are negative, PV will trade at a premium, or the zero coupon bond is going to trade at a premium, and that only happens when the rates are negative. So in a zero coupon bond, when will a bond trade at discount? When rate is positive, and bond will trade at a premium where R is negative, a zero coupon bond. Any question? So that is what this example is trying to tell us. And in
So
that case, yeah,
what would be the use of such a bond if I have to pay a premium and my future value would be less than my present value?
there will be no practical use of this bond. But I can use this bond for shorting, doing the reverse. For hedging purposes, I can use this bond.
Okay.
Because today the value is more, in the future the value will be less deterministically. So such a bond can be used for shorting and in a reverse way earning a positive yield. So can I say that if the return is positive, I can go long the fixed income instrument and I will get a positive return? Yes or no? Because the present value will be less than future value. But if a rate on the bond is negative, it makes more sense for me to short that fixed income instrument and still earn a positive return. And that's because PV is greater than FE. It's trading in premium. So I will short such a bond so that suppose the present value is 1050, and after a few years or few quarters, I will end up getting 1,000. So deterministically, I know that something which is worth more today will end up with a lower future value. This obviously I will again do by comparing my base rate or comparing my borrowing cost with that. Suppose I'm shorting the bond and I'm also borrowing money to short the bond. Now my borrowing rate has to be less than the return which I earn or the yield to maturity on this zero coupon bond or the IRR of this bond, internal rate of return. Only if the IRR slash YTM on this ZC zero coupon bond is greater than my YTM. Yeah, sorry, greater than my borrowing cost. Only then will I enter into a short position on this bond. Makes sense, right? So suppose I'm earning negative yield of 1% and my borrowing cost is say quarter basis points, which is 0.25%. Then it makes sense. So IRR is 1%, borrowing cost is 0.25%. Then I will do this. If it is reverse, I will not do it. So this is a practical usage of a bond which could be trading at negative yields. I can use it to short and hedge probably a portion of my fixed income portfolios or another portion of my trading books, where I will also earn some return on the hedge, which is yielding negative returns from. This is a practical example of how this can be use to our benefit. Make sense? But I will
Yes.
never invest this. Suppose it basically means that you go to a bank and bank says that the FD return is negative 1%, which means after 1 year, if I invest 1 crore, I'll get 99 lakhs back. What is the point of doing that? Yeah, so practically it makes no sense. So practical investments will never be done in that fashion. But if the borrowing cost is lower than that negative yield, then it might make sense to do something with that bond. Make sense?
Yes, sir.
Okay. Next. So application one was zero coupon bond. We have looked at that bond where there are no coupons. The second application is with respect to coupon bearing bonds. That's the second application. So in coupon bearing bonds, you receive regular coupons, and at maturity, you also receive coupon plus the par value back. Whatever par value is basically face value of the bond. It can be 100, it can be 1,000, which we have looked at in our example. Yeah. So this application two, the example is, let's say we have a 10-year 1,000 par value, which is face value is 1,000, and 10% annual coupon bond. Now it's important to understand the fixed income bond convention. Whenever I write 10% annual coupon bond, this is not the yield to maturity. This is your coupon rate, and that too is the annual coupon rate. Yeah, so that's the annual coupon rate, 10%. Now they're asking what is the value of this bond if the YTM is 8%. So yield to maturity is 8%. Par value, can I say that is your future value is 1,000? And the question asked is what is the value? Basically, what is the present value today? They are asking. So in terms of cash flow diagram, can I say you earn 10% every year on the par value? Please note your par value is 1,000. So coupon will be the coupon rate in percentage terms into the par value. So it will be 10% of 1,000 and it will be 100. And that's what we're seeing here. Every year you earn 1,000 coupon. Uh, in year 10, you also earn your coupon, which is 100, and you also earn the face value, which is 1,000. So you earn both the amounts. It's a 10-year bond. And what is the price of such a bond if these are the constant cash flows and towards at the end of the 10th year you also earn back the future value? So the what is the price today? Yeah. So can I say every cash flow, future cash flow, I need to discount back to today? Every cash flow I need to discount back to today. So let's quickly do it on Excel. So this was the sheet for zero coupon bond. Now for coupon bearing bond, let's quickly write our assumptions. So what are the assumptions here? 1 second. Yeah, so the assumptions here are the time period, the future value, the coupon rate, and the yield to maturity. Yeah, so future value is 1,000. Coupon rate is 10%. Your time to maturity is 10 years. Your YTM is 8%. And you've been asked what is present value on this bond, yeah? So one way is the cash flow diagram method, which is very long. But let's look at how to do it using that. So cash flow diagram method, in which I will write the year in the first column. So years 1, 2, 3, all the way till 10, right? Next will be cash flow. Next column will be present value of the cash flow. Now, what is the cash flow? Cash flow is nothing but coupon into the future value. I freeze these cells. So can I say my coupon is 100 And in year 10, I not only receive the coupon, but I also receive the future value or the par value on the bond. Now, present value of this cash flow of every cash flow is nothing but take the futuristic cash flow divided by 1 plus yield raised to the period in which you are sitting. So this cash flow in row number 10 is for the first year. So I will raise it to 1. I can drag it down, and the second year's cash flow will have to be raised by 2. So it's basically we are doing this year 1, 2, 3, 4, right? In year 1, 100 is your coupon, year 2 also 100, and so on and so forth. In year 1, if I want to find the present value, it will be 100 divided by 1 plus 8%, which is your R raised to 1. If I want to find the present value of this cash flow, it will be 100 divided by 1 plus 8% square, because there are 2 periods involved. You're discounting twice. Similarly, third years has to be discounted 3 times. So 1.08 cube, and so on and so forth. So that is exactly what we are doing here. I will be dragging this formula down. And finally, the present value of this coupon bearing bond will be the sum of all the present values of each cash flow. So this is PV1, this is PV2, PV3, so on and so forth till PV10. And if you sum all these PVs, you end up getting the present value of the coupon bearing bond, which in this case is 1134.202. And that's what we are getting here. In the calculator, we are going to key in the number of years, I by Y, which is the rate, PMT, which is constant. See, now you have coupon. So hence PMT will be keyed in as 100. In zero coupon bond, we had keyed in PMT as 0. Future value is 1000. And if we compute PV, this is what we get on the financial calculator. Should be the same. Since this bond trades at a premium over the future value, and that's the premium is because its coupon which you're earning is greater than the yield. Now, in the numerator, can I say what is this 100? 100 is basically, can I say, coupon percentage into face value or par value. And in the denominator, you have 1 plus R percent raised to T. Yeah. So when will a coupon bearing bond be in premium? Coupon bearing bond will be in premium if C is greater than Y. If that happens, your numerator is more than your denominator, and hence the price of the bond will be greater than the face value. So we say bond will be in premium. When will this bond be in discount? It will be when the coupon rate, which is numerator, is less than YTM, which is the denominator. So whenever coupon is less than yield, suppose you're earning 4% coupon, but the yield on the bond is 8%, that bond will trade in discount. And there is also a concept of a par bond, which means it's trading at 100. This is trading at less than 100, sorry, greater than 100. And this is trading, discount is trading at less than 100. Par bond will trade at 100 or at face value of the bond. And that will happen when C is equal to R, when the coupon rate is equal to the YT. Yeah? Any question?
Yes, sir.
Okay, so this is in the case of coupon bearing bonds. So this is application 2. What is the difference between coupon rate and yield to maturity? Coupon rate is the numerator, which is what is the cash flow. It's related to cash flow. Yield to maturity is related to discount rate. So that will go on your denominator. So that's your discount rate. At what rate the futuristic cash flows are you going to discount back to today? Or what is your internal rate of return? Yeah. So that's your yield to maturity. Do not confuse coupon rate with YTM. Both are rates, but one is numerator or cash flow rate or the earning rate. The other is the discounting rate, which is YTM. Okay. There's a type of cash flows which never end. They are called as perpetuities. They will never end. So, for instance, suppose you receive a constant cash flow, say C, all the way till infinity. By the way, the practical application of this is perpetual bonds. There are bonds called as fixed income instruments called as perpetual bonds, which keep paying you the same coupon rate every compounding period till eternity. So, what is the present value of such a bond? The present value of such a bond is given as this. PMT divided by R, which is nothing but C divided by R. Okay, so that's the present value of this perpetuity. Now, how do we get C by R? Any clue? Anyone, any clue? How do we get C by R? Formula. Should I show you quickly?
The
Yes,
infinite
sir.
GP formula.
Yeah. And in the GP, there is no growth here in this. So infinite GP formula is what? A divided by 1 minus R, right? Correct? And what is A? A is the first term of the GP. And can I say A will be multiplied by R, right? Throughout. But I can't use this formula at all here. Can I? This formula I can only use when R is less than 1. So I can't use this. So how do I get to this formula? So perpetual bond formula is C by R. Okay. Can I say these are the cash flows? Every year we receive C. Can I write this first cash flow as C by R? Or sorry, C by 1 plus R. Second cash flow is what? C upon 1 plus R square. Correct? Yes or no?
Yes, sir.
Third cash flow, I'm taking present values of every cash flow. This is PV1, PV2, PV3, and so on and so forth, right? And keep on doing that. Now, clearly, and PV3 will be C upon 1 plus R whole cube, and so on and so forth. Do this till infinity. Now, if you take the present values, you can use our GP formula. Yeah. Now, can I say what is A? The first cash flow? C upon 1 plus R, right? That's my first present value, right? C upon. So that's your first term. And can I say the ratio R, constant ratio R is what? 1 upon 1 plus R. Can I say?
Yes, sir.
That's your constant ratio between the two terms. Hence, now I can apply the GP formula. So that will become A divided by 1 minus R, which is C upon 1 plus R divided by 1 upon 1 plus R. Yeah. 1 minus this. And if you take 1 plus R common, this is what you get. So GP, which is nothing but summation of all the present values, will fetch you the present value of the perpetual bond today, which is C upon R. So that's how you get the formula C by R. Any question?
No,
Yeah,
sir.
so those are the mechanics behind that formula of how did we get that C by R all of a sudden. Yeah. So this is present value of a perpetual bond. So that's another example. Application 3 is to find the payments for amortizing loan. What is an amortizing loan? An amortizing loan is which involves level payments, which include a portion of both principal and interest over a period of time. So that by the end of year T, the principal is down to zero. And that typically is the case, right? In an EMI, when you take an EMI from a bank, you take an EMI from the bank, there will be both principal repayment and also there will be interest portion on that, right? Now they are asking what is EMI? That's the question. So that's application 3. So in this case, can I say present value of the loan is known because I take a $2,000 loan. Yeah. It's to be repaid with equal suppose end of year payments in this case over a period of 13 years. So your time is 13. Your rate of interest R is 6%. They're asking you what is the annual payment. So in the financial calculator, how do we do that? You put N as 13, I by Y as 6, which is rate as 6, PV as 2000, future value is 0. Future value is 0, why? Because you end up paying the loan fully, right? And what are we being asked? What is this constant payment or constant EMI? Can I say EMI is constant every year or every month in reality? Here we are taking annualized concept. So EMI will be constant every year. And what is the EMI? They are asking you, what is the constant payment? So when we solve for this, we get this. In Excel, how to do this? Let's look at Excel now. So in Excel, there is a formula which is called as PMT formula, which will help you do this. Some assumptions, N is 13, rate is 6%, your present value is 2000. You're asked what is, also your future value given is what? 0. Because the loan becomes 0 at the end of 13 years. You're asked what is payment. So we use a formula which is PMT, in which we supply the rate, we supply number of periods, we supply present value, future value obviously is 0. And if you do that, you get PMT as 225.92. Yeah. So this is how it works. Again, the question here is, okay, in type, there is something called as type. If you want end of period, you can put 0. If you want beginning of period, you can put 1. Yeah. Usually we put end of period, and hence this is your answer using Excel. So this is how we solve this problem, which is what is the constant payment every year? So the annuity cash flow stream is something which is unknown, which can also be found out both using a financial calculator as well as Excel. Next. Yeah. Okay, so as soon as we move from debt to equity, can I say that the cash flows will become uncertain? And hence the valuation methods will become more complex. The estimation of cash flows also we'll have to use some advanced techniques for equity valuations. So as soon as you move to equity, debt we know deterministically, we know the coupon rate, and hence we can find the present value very easily because the coupon rate is known. In equity, there is no coupon rate, right? Rather, these are all futuristic cash flows, which we do not know. So hence valuation of equity becomes much more complex versus debt. Application 4 is something which is in between uh, a debt and an equity is called as preference shares. Okay. Let's quickly look at this concept. So on one end of the spectrum, you have debt. On the other end, you have equity. In debt, you have coupon rate. In equity, there is no coupon rate. Rather, you might have dividends, could have dividends, but they are uncertain in nature. But coupons are certain. The rate is also known in most bonds, except for floating rate bonds. In fixed rate bonds, the coupon is already always known. In floating rate bonds, the coupon is not known because that is linked to a fixed income benchmark, like a SOFR rate. But In between, you have, so these are two ends of the spectrum in terms of capital structure. In between, you have something called as preference shares. In preference shares, there could be a debt element and there will be an equity element. The debt element could be you'll have preference dividends, which will be fixed, just like coupons are fixed. So if the preference dividend rate is known, which is fixed rate, we can value the preference shares. And at the end of the period, the preference shares have a possibility of getting converted into equity. Yeah, at maturity or at some period. So how will you value a preference stock or a preferred stock with a perpetuity model? So here is an example. A company has $100 preferred stock, yeah, which pays $5 annual dividend. So can I say your preference dividend is $5? And that is your constant cash flow every year. It will go on till perpetuity. Required rate of return is 8%. So what is the value of this preferred stock? So can I say value of the preferred stock is nothing but C by R? Yeah. So your preference dividend is your coupon substitution. And instead of discount rate, we are taking the required rate of return on the preferred stock, or cost of preferred stock is your denominator. So D is 5 and R is 0.08 and the value will be $62.5. Yeah. Any questions on this?
Yes, sir.
Okay, next. So we have looked at the valuation for debt. We have looked at two cases. One is zero coupon bond. We have looked at coupon bearing bond. We've looked at preferred stock valuation as well. Now the question comes, how do we value equities? So we have looked at all these cases in the previous applications. Now the question is, how do you value equity using time value of money? So let's look at that. So modeling the future, when we talk about common stock valuation, okay, we can have three different kinds of models for the same. One is called as constant dividend model, in which you're assuming the company is going to pay you almost equal dividend across till infinity. So assume dividends remain fixed forever, like a perpetuity. The second case is where you assume that you have some rate of growth, which means the dividends are going to increase at a certain small growth rate G every year, forever. And the third case is multi-stage growth model, in which maybe in the first few years, the growth rate is aggressive. Then in the next few years, the growth rate comes down a bit. And beyond a certain period, after that, the growth rate is the lowest. So you can assume different growth rates for different periods. So that is multi-stage growth rate model. So these are three different ways in which we can assume or we can carry out valuation for common stock. This will be covered in detail when we go to equity valuations. That's a different reading and different section altogether. But in terms of simple time value concepts, how do we apply the valuation or the value of time value of money concepts in terms of constant growth of dividends? Assume dividends are growing at constant growth rate. That model is called as Gordon growth model. Okay, it has a name called as Gordon growth model. So this application 5 is with respect to that. So what is the scenario or the problem here? The problem here is find the value of the stock that expected to pay 1.62 dividend next year. So that becomes your D1. So D1 next year is 1.62. Dividends are expected to grow at 8% forever. So that's my growth rate of dividends, 8%. And required rate on equity is 12%, which means my discount rate or the cost of equity is 8%, is 12%. That is your KE. So that's your 12%. Growth rate is 8%. in that case, we are going to use a modified version of the formula. So earlier we had looked at the formula d by r, right? So now the formula changes to d divided by r minus g, where g is the constant growth rate. So how do you get this formula? Again, we can use the same perpetuity concept and get this formula. For instance, in this, we can one second. We can use the same perpetuity concepts. So can I say I will use same A upon 1 minus R, right? GP is equal to, but here the growth rate is slightly different. Okay. So here, suppose you start with D. Okay. So can I say in the next period, what is my dividend? The dividends are going to grow at G, constant growth rate. So can I say in the next period, dividend is 1 plus G, right? In the next period, 3, dividend will be what? 1 plus G square, and so on and so forth. So when I take the present value, in the first case, PV1 will be what? D upon 1 plus R. In the second case, PV2 will be what? D upon D into 1 plus G divided by 1 plus R whole square, and so on and so forth. So my first term is what? This, right? My A is D upon 1 plus R. And what is my constant ratio? It is not 1 upon R, 1 plus R. It is 1 plus G divided by 1 plus R, right? That's my constant rate. 1 plus G upon 1 plus R. And now I will use this into this formula to get the present value of all the cash flows. So that's how we get this formula, which is D upon R minus G. So when we substitute for, please note this D is always the dividend of the first year, okay? Not the dividend today. Do not take year D0. It's not D0. In this formula, D or the constant cash flow assumption is from D1 onwards. Okay, so always in the numerator, take 1 year ahead and then you discount it back to 0. So the way you remember this is always in the numerator, take the formula which is for dividend 1. Take always the first year dividend and then divide by KE minus G. K is nothing but R, discount rate minus G, which is the growth rate. So if I substitute for all these, I end up getting the value as 40.5. That's the value of the common stock, assuming that dividends are growing at 8% and the first dividend next month is at $1.62. Any questions?
No, sir.
Okay. So this is our application 5, which is constant growth model. And finally, how do we apply that to multi-stage? Okay. In phase 1, we apply high growth. So suppose we say that the stock dividends are growing at very high rate for 2 years. And in the cash flow diagram, clearly, suppose last dividend was D0 was 1. So can I say the dividend in the first year is 1 into 1.115 because the growth rate is 15% in the first couple of years. Similarly, D2 is D1, which is 1.15 into 1.15 because it's growing at 15%. Yeah. So these are your two explicit dividends. You can find their present values of these two. And in phase 2, which is the stable growth period, for 2 years, the dividends grow at 15% and till perpetuity after that, they grow at 5%. So G2, which is the growth rate of dividends, is 5%. Okay. Now, please note that applies to all the cash flows from year 3 onwards. So your D3, you need to first calculate D3. So your D3 is what? your D3 is D2 into 1.05 because the growth rate for the third period is 5% and not 15%. So this becomes your D3, 1.3886, and you do that till perpetuity. Yeah. So what is the value now, or what you get? The value of what you get. Okay, let me just draw another diagram here. So explicitly we are doing for the first 2 years because the growth rate is very high in the first 2 years. Yeah. So dividend 0 we know as 1, right? Dividend last year was 1 year. So dividend D1 will be 1 into 1.15. Dividend D2 will be 1 into 1.15 square. And dividend D3, which is all these cash flows now growing at 5%. So D3 will be D2, which is 1.15 square into 1.05. Right? Now you can calculate the present value 1 year, which is present value of the first dividend, and that will be 1.15 divided by 1 plus R. The rate of return is 11%, so that becomes my discounting factor. So 1.11. The second year's dividend, if I discount it back, I call that as PV2. So that will, can I say, will be 1.15 square divided by 1.11 square. And can I say now, this is a constant, is a perpetuity, growing perpetuity. D3, D4, D5, all will grow at 5% growth rate of the dividends. And we have just learned that present value of these cash flows are using this formula, right? But please note that will be your D1 needs to be supplied and then you'll get a PV0. But if you're supplying D3 inside this formula, the present value which you get is at the end of the second period because you're using the next period's dividend. So your perpetual dividend stream starts from year 3 onwards. So if I'm using this present value formula, that present value you're achieving or arriving at the end of year 2. So what is that? So that is PV3 now, okay? Or rather, let's call it PV of perpetual dividends. Can I say is nothing but equal to D3 divided by R minus G. What is D3? We've just calculated. We know what is R, we know what is G. We can calculate PV, PD, but that will be at the end of the second year. You need to discount it back to 2 years, and that will fetch you PV3. So PV3 will be nothing but PV, PD, which is present value of perpetual dividends or growing dividends divided by 1.11 square. Yeah. So you have to be careful in multi-growth model. Whenever you're applying the perpetuity formula there, you will always get that value one period before. So if you're using D3, you will get the value at 2. Now that now that present value which you get of the growing dividends or using the Gordon growth model is not the actual present value. That needs to be discounted further by 2 years, and that will fetch you the present value today. So this is the PV of the dividends at the end of year 2, but you need to discount it back by 2 years, and then you will be able to find the PV today. So that is how you can solve the multi-stage growth model. Any questions on this? Okay. So then finally, can I say value of the common stock will be what? Value of the common stock today will be equal to PV1 plus PV2 plus PV3, where PV3 is the present value of the Gordon growth present value formula. But you'll have to discount it back by 2 years. So this is where many CFA candidates make a mistake of not being able to understand that whatever you get using the Gordon growth model, that is at the end of 2 years because you're using the third year dividend, because these third year dividend onwards are growing at a constant rate G. You will get the value at 2, you need to discount back by 2 years, and then you will find what is PV3. Combination of all these will fetch you the value of the stock. This is using the multi-stage growth model. Okay. So this is how it looks. Any questions on whatever we have done?
Not yet, sir.
Okay. Yash, anything?
No, sir.
Okay. All right. So those are the various scenarios which I wanted to talk about. Okay. A couple of other things with respect to this chapter is there is also in this reading something which is discussed as no arbitrage. Okay. Now, what is no arbitrage? Let's try to understand this. Now, we've already seen. Okay, so suppose if I give you this is a complex cash flow diagram. Okay, complex cash flow diagram. How can you divide it into simple ways of valuing this complex cash flow diagram? In this cash flow diagram, there's 100 at the end of year 1, there's 100 at the end of year 2, there's 400 or 4 blocks at the end of year 3, and there's another 100 at the end of year 4. Can I say if I deconstruct this, the first part will be a 4-year annuity, which is the base level. The base level. Can I say there's 100 cash flow every year, right? And then on top of it, at the end of the third year, there are 3 blocks which are additional. So can I say this original stream can be written as annuity stream, which is a stream every year for 4 years, and then a lump sum. Lump sum is what? Some lump sum cash flow. In the third year, we have a lump sum of 3 blocks. Yeah. So if I were to solve this present value of this original problem, this I can divide into 2 parts. One is present value of the annuity, and second is present value of the lump sum. Yeah. So can I say I can break down this complex instrument into 2 types or 2 parts? One is annuity and the other is lump sum. And the present value will also be equal, the future value will also be equal. And that is called as no arbitrage. So when the present values of LHS is equal to RHS of the original and the broken up stream, if the present values of are equal, that's called as no arbitrage, which means there is no arbitrage in that. So that's the concept of arbitrage. So you have a complex instrument, you divide into 2 or more simpler instrument. If you take the present value of each of these, okay, so how does that apply to finance? Okay, so let's see that. You have a complex instrument and you divide that into simpler instruments. Simpler instrument 1, 2, it could be also more than that. Yeah. Now, if I say I take present value of this complex instrument and I take present value of simpler instrument, the no arbitrage pricing states that the present values are equal of the LHS versus the RHS. So the original instrument versus the broken down instrument, their present value should be equal. So also that's called as law of one price. Two same things cannot have two different prices. If they have two different prices, then there will be arbitrage. Okay. So what is arbitrage? Arbitrage means, so can I say in our case, we have present value of CF, complex financial instrument, equal to PV of simpler instrument, PV of simpler instrument 2, and so on and so forth, right? Now, law of one price states that prices are the same for both these complex as well as the simpler instruments. But if they are not same, there will be arbitrage in the markets. And what is arbitrage? First case is complex instrument more than simpler instruments, which means what? It means PV, C of I greater than the summation of all these PVs of simpler instruments. If that is the case, then you should short this and you should go long the simpler instruments. And the profit between the prices of these two is your arbitrage profit. In the second case, which means the complex instrument is cheaper. Whatever is cheaper, you go long, and whatever is more expensive, you short. So in arbitrage, the rule is always whatever is expensive, you're going to short it, and whatever is cheaper, you will go long. Okay? So when the law of one price doesn't hold true, there will be arbitrage for a short time. And arbitrage will be of two kinds. You can either short the LHS or you can go long the LHS, depending on what is relatively expensive or cheaper. Any questions on this?
No, sir.
No,
So that is your law of one price or no arbitrage. Okay. So where is this applied? Or law of one price or no arbitrage? That is applied in pricing some future instruments. So that is applied in interest rates when we are talking about forward interest rates concept. That is also applied to forward forex rates, and that is also applied to option valuation. Let's see how are these applied. Now there's something called as forward interest rates. What is the meaning of forward interest rate? Okay, there are two types of rates. Okay, one rate is called as spot rate. These are concepts related to fixed income world. One is called as spot rate and the other is called as forward rate. Now, spot rate is nothing but the rate from today in the future. Because you start investing today, it's called a spot rate. Forward rate is a rate which will start in the future. So suppose your rate starts in the future until T. So since your rate starts in the future, that's called as a forward rate. Okay. So that's the difference between a spot rate and a forward rate. So forward rate is an investment that starts in the future for a further period of time. Now, how do we apply this law of one price to find the forward rate? So suppose I have the yield curve with me, fixed income yield curve, in which I know what is the spot rate at the end of year one. I know what is the spot rate at the end of year two. See, since bonds trade in the market, their yield curves will be available to us. And hence, we will have their spot rates available to us. But forward rate is something which is not directly visible. So how to find the forward rate? No arbitrage forward rate. For that, we assume that you can start investing today for 2 years directly. And that you can do using S2. So what is S2? S2 is the rate earned from time 0 to 2. Every year you will earn S2. That is what it means. Which means in first period I will earn S2, in second period I'll earn S2. So that is the meaning of spot rate 2. So if I tell you that spot rate 2 is 10%, it means in the first year you earn 10%, in the second year you earn 10%. It's known. On the other hand, what is S1? S1 is the rate earned between 0 and 1. Okay. So either I invest for 2 years today itself at the rate of S2 in each year. Both are known. I mean, it's the same rate, S2. Or the other case is I invest first between years 0 and 1 at a rate which is S1, because S1 is the rate between 0 and 1. And then I can invest in the forward rate between 1 and 2. I can invest in the forward rate between 1 and 2 at the rate F12. Now the question is, what is F12? Given that I know the yield curve, which means I know what is S2 and I know what is S1. Okay, so how do we do this? It's very easy. Suppose we start with $1 today. What will be the value of $1 at the end of 2 years using the first method where I invest bulk for 2 years at the rate of S2? So can I say this $1 will become 1 plus S2 whole square? Correct? This should also be equal to, if there is no arbitrage, this should also equal to 1 plus S1, which is investment for 1 year, into investment for another 1 year between 1 and 2, which is 1 plus F12. If both of these are equal in the absence of arbitrage, I can then find what is F12. So that's how I find the forward rates if I know the spot rates, assuming no arbitrage. Any questions on this?
No, sir.
Okay. And that's exactly what we are doing on this slide. Yeah. We are saying in this question, okay, what is the implied 1 year loan that begins 1 year from now for another year? So we are basically saying the loan starts in 1 year and it's for another 1 year. Basically, we want to find what is F12. Okay. Now assume that we can observe today's spot rate S1 and that's 2%. Assume that the 1 year spot rate is also known, which is 1%. So S2 is 2% and S1 is 1%. So can I say this is what we had just seen? We can apply S2, S1, and we can find this forward rate, which is F12 in this formula. And once you do that, we find the forward rates. So this is another application of no arbitrage pricing or law of one price. So that is applicable in interest rates where there will be parity between forward rate and spot rates. So you can find the no arbitrage forward rates using this method called as law of one price. So for that, we use this concept and this formula is used. So what is F12? F12 hence can I say will be equal to what? 1 plus S2 whole square divided by 1 plus S1 minus 1. Okay. Now I have a simple question for you. How will I find F23? Can you tell me the formula for F23? Also, I will write the formula for you for F12. I'll put it there. So this is for F12. How can I generalize for F23? Can I generalize? What is F23? How can I find F23?
1 plus S2 the whole cube. No.
It will be 1 plus S2 whole cube by 1 plus
No.
S1 square minus 1.
No, it will be 1 plus S3 whole cube. Because the first case, you will be assuming that you are investing for 3 years at the same rate S3. It will be 1 plus S3 whole cube divided by what? Then you assume that you invest for 2 years at S2. S2 is the rate for 2 years. S3 is the
Yes, sir.
rate for 3 years.
Okay.
Correct?
Yes, sir.
And then can I say minus 1 because it's a 1 year period? Can I say this?
Yes, sir.
Yeah. And what will be F34?
1 plus
1
S4
plus
के power 4.
raised to 4
Yeah.
upon 1 plus S.
S3
Excellent. 1 plus S3
3 the
whole cube?
yeah,
Yeah.
minus.
Okay. Now I have another question. What will be F13? So what is the diagram we'll draw? First take the end, right? So one assumption will be invest at S3 for 3 years.
So 1 upon S3 the whole cube upon.
And second will be what? Invest in S1 for 1 year and then invest for 2 years at which rate? F13. See, F13 is a 2 year rate. Please note the difference is 2 years in between.
Yes, sir.
So that rate will be applicable for two periods. So can I say this will be 1 plus S3 whole cube and this will be 1 plus S1
Yes.
into 1 plus F13 whole square.
Yes, sir.
So how can I write F13? Can I write S1 plus S3 whole cube divided by what? 1 plus S1?
and this whole under root.
Correct. It will be 1 by 2 raised to 1 by 2 and then minus 1. Correct? So can you tell me how to write F24? One plus S4, right? Raised to 4 divided by what? 1 plus starting period.
S1
S2.
The whole square.
The
square.
whole square. And raised to what? Half. Because the difference is 2 years, correct?
Yes, sir.
Minus half. Correct. So this is how generically we can directly write the formula, even without doing these steps. Or if you're not comfortable, you can do these steps and then equate and find the formula. Yes, so this is the law of one price or no arbitrage in the case of forward rates in fixed income world. Okay. Any questions on this? Okay, what will be F36?
1 plus S6 की power 6 upon 1 plus S3 की power 3 and this whole raised to the power on 1 by 3 minus 1.
Yeah, correct. Absolutely. Sorry, my PowerPoint is stuck. Just give me a second. Huh? Okay, next thing. Next thing is, hope my screen is visible.
Yes, sir.
Okay. So we have seen the no arbitrage principle or the law of one price in the case of interest rates, where we looked at the spot rates, right? Similarly, we can also do that for forward exchange rates, okay? Which means that you can do a domestic investment at the spot rate or you can do a foreign investment, okay? So the formula becomes this for forward exchange rates, where the forward rate is equal to spot rate into 1 plus interest rate domestic divided by 1 plus interest rate base currency and price currency. Okay. So 1 plus interest rate price divided by 1 plus interest rate base or domestic. So this is foreign, this is domestic. So concept is the same. The only thing is when we are dealing with foreign exchange, we are dealing with two interest rates. Any foreign exchange is basically a pair, currency pair, CC1, CC2. Yeah, their interest rates would be different. Suppose R1 is the rate here, R2 is the rate here. So you'll have to take the interest rate differential also into consideration while finding the forward rate. So forward rate is equal to spot rate into the interest rate differentials between the two economies. So that's the whole crux behind finding forward exchange rates. We have looked at forward interest rates already. Yeah, where we looked at forward rate. Now we are looking at forward exchange rates, not interest rates. So these forward exchange rates is nothing but the forward exchange rate equal to spot exchange rate into the interest rate differentials between the two economy. If any two economies have the same interest rates, ideally their exchange rate should be the same. But typically, if you look at interest rate between India and US, right? So the spot rate and the forward rates will be different for USD INR. And the reason is because the US rates generally are lower as compared to Indian rates. So how will I apply this? Okay. So let's look at that. So this is the formula. Forward forex rate is equal to spot forex rate into 1 plus rate foreign divided by 1 plus rate domestic. Okay. And if you're dealing with T years, then you can also raise to T. Raise to 1, but you can also raise to T if you're dealing with a T period forward rate. So right now we're dealing with 1 period forex rate. So hence I will raise it to 1. If you're dealing with T period, you will use raise to T. Yeah. So what is the difference between spot and forward? If two economies have the same rates, okay, so if there's always a foreign rate and there's a domestic rate, let's take the example of USD INR. USD INR, can I say domestic rate is INR, foreign rate is USD? Suppose domestic rate is 7% and the dollar rate is 4%. So can I say what is the differential? Yeah.
So,
Differential,
three.
can I say is 3%, right?
Yeah.
Now this 3% should be adjusted for year. Okay. That is what it means. Yeah. But it also depends on what is the convention. Okay. Now here what I've written is this is the formula for an indirect convention. In this indirect convention, if I'm taking foreign above and domestic below, the forex convention also here is foreign divided by domestic. But if I say my rate is USD INR is the pair, it means my primary is USD and my secondary is INR. It means the way I will quote this is actually INR upon USD. Please note. Because if I say the rate is 90 today, what does it mean? It means $1 buys 90 INR, right? Can I say $1 buys 90 INR? So always my first currency is primary, the second is secondary. So when I'm writing this formula, I need to be careful of what is my convention of the FX. If I'm writing this formula, my FX convention is foreign divided by domestic. But if I look at USD INR, the quote is opposite. Yeah, where domestic is above and foreign is below. So how will this formula look like if that is the case? So this formula will have to be modified. So this is the formula for indirect FX rates. For direct FX rates, the formula will be slightly different. You'll have to just flip the domestic and foreign currency interest rates. So the forward forex rate, which is nothing but domestic divided by foreign, will be written as spot FX into 1 plus R domestic divided by 1 plus R foreign. You're just flipping these two rates. So now if I tell you that INR rate is 7% interest rate and US rate is 4%, can I say INR is higher? So if I apply this concept, can I then say that your forward USD INR rate will be, can I say, more than spot USD INR rate? Yes or no? Because this interest rate differential is positive into interest rate differential, which is positive. If this is positive, then your forward rates will be higher than spot rates. That is what I'm getting to. Okay. So on the CFA, you have to be careful in terms of what are the units of the foreign currency versus domestic currency, and then apply the interest rate differential. So whether foreign goes above or domestic goes below or domestic goes above will depend on the units of this currency as to what are the units, whether foreign is on top or domestic is on top. If foreign is on top, then use the foreign rate above. If domestic is on top, then use the domestic rate above. Whichever is the rate above, you use that as the interest rate in the numerator. Also, your rate below is called as primary and your rate above is called as secondary. So always have the secondary interest rate on top and always have the primary interest rate at the bottom. This is another way to remember it. So use the proper version of the formula. That's what I'm trying to say. Any questions on this?
No, sir, understood.
Okay.
So
All right. So now, okay, I have a small example here. Suppose we have a scenario where there are these two fictitious currencies, ABE and DUB. Okay. Suppose ABE rate, interest rate is 5% in ABE and interest rate for DUB is 3%. Now spot rate is given. ABE by DUB is 4.5671. How do you find the forward rate of ABE to DUB? So obviously we'll use this formula. Okay. Also, please note, we are using what? In this note, what is the convention of this rate? It's, can I say the units are ABE to DUB, correct? So hence, I will in this formula use in the numerator the interest rate for AB on top and interest rate for DUB at the bottom. Okay, so hence I'm asking you to be careful. So whatever is in the numerator, that currency's domestic rate you'll use in the numerator. Whatever currency is in the denominator, you will use that in the denominator as the interest rate. As simple as that. So in this example, when we use the formula, we get forward rate as 4.6558, and that is nearly 2% higher than the spot rate. And that's exactly, very similar to the interest rate differential, which is 5 minus 3. Shortcut is 5 minus 3, but actually the interest rate differential is 1.94% because of the compounding which you have to use. 1 plus R divided by 1 plus R. Make sense?
yes, sir.
Any question on this? And last thing for today is the third application of no arbitrage in reading 2, which is an application for options. Okay. Now what they are saying is that you can replicate non-linear payoffs or option payoffs with simpler things. Okay. So what they're saying is you can use, sorry. So they're saying you can use stock and bond to get to an option. So they're saying you can use stock and bond to get to an option or replicate an option. So if three instruments are involved, you can also flip it. You can use a stock and an option to also recreate the third instrument, which is bond. Okay. So this is the basic crux of risk neutral pricing, where you are using stock and option cash flows to get to a bond cash flows. So that is called as risk neutral pricing. And that's basically what they're trying to discuss in application 3, which is low arbitrage pricing. How does this work? We take a simple binomial approach here, which means you have the stock, which is at $50 today. There are only two choices for the stock, either to go up or go down. We are assuming stock goes up by $10 to 60, or stock falls by $5 to 45. So up move of the stock SU is 60 and down move of the stock SD is 45. Okay. And hence you have two call prices at the end of that one period. And please note, the mechanics of the call price are these. The exercise price on the call is $55. So your K is 55. So can I say that at maturity, also at maturity, what is the payoff of a long call? We know this, right? Payoff of long call is equal to max of ST minus K comma 0. Diagrammatically, it looks like this. So only if the stock price is above the strike price can I say the option will have some value at maturity. Otherwise, value will be 0. So basically what we're trying to say is value of long call at expiry will be equal to ST minus K if ST is greater than K. And if ST is less than equal to K, then that value will be 0. Yes or no? There will be
Yes,
no
sir.
time value left of the option at expiry, only intrinsic value. And hence, intrinsic value is the difference between stock and strike. Correct? So in this example, can I say if the stock ends at 60 and strike price is 55, what is the value of the option at expiry? 5, right? ST is 60, right? In this case.
Yes, sir.
And strike price is 55. So the difference will be the call price. Similarly, in the second scenario, which is the stock going down, ST will be 45. ST is less than K, so value of the option is 0. Yes or no? So I have the stock price and I have the call price in each of those two scenarios. Now comes how can you price the option using no arbitrage? So what we are arguing is the present value of the stock, the present value of the option should give me the present value of the bond. And I know stock and I know bond, so I can find the value of the option. This is unknown. So they're asking us what is the value of the call option today if stock plus option can give you a bond, which means risk-free cash flows. How are we achieving risk-free cash flows? Let's look at this. So first of all, we are calculating something called as hedge ratio, which means I'm combining, can I say I'm combining stock and call option in a certain ratio. That ratio is not 1:1. Okay. I can't combine them in the ratio 1:1. I need to find this ratio. So this ratio is one call and delta times stock. So what is delta? Delta is nothing but change in the price of the call divided by change in the price of the stock. So we know what the values are in each of the cases. So when the stock goes up, the value of the call option is 5, which we saw on the previous slide. And when it goes down, the value of the call is 0. Divided by, so 5 minus 0 is numerator, divided by 60 minus 45. So hedge ratio becomes 1/3. So which means you're creating a portfolio which is 1/3 stock and call, and you are creating a bond out of it. You can't mix them in 1:1. That will not fetch you a bond. That how much of stock to put. So that is your hedge ratio, H. So that is your H. So that we found out in the first step, which is 1/3. And then we say we create a portfolio. What is a portfolio? The portfolio is nothing but is nothing but 1/3 stock plus option or call. This is your portfolio. Now, can I say portfolio will have two values? Either portfolio will go up or portfolio will go down. If portfolio goes up, 1/3 of stock minus call, okay, will fetch you 15. Similarly, 1/3 of stock, which is 1/3 of 45, minus value of call will fetch you 15. So can I say that value of the portfolio is the same in both the cases? Value of the portfolio is same in both the cases. And you will do exactly the opposite. Please note, why is there a minus here? To hedge. What do I mean by hedging? Can I say that, and this is important to note, when I say hedging, hedge ratio is nothing but hedging, right? So how much stock should I use against the call to get a bond or risk-free rate is the question, right? Then I said we use delta. Delta is what? Change in call divided by change in stock. We can get delta. But please note these are in opposite directions, which means if I buy a call option, can I say the payoff diagram looks like this? Stock has to hedge it, right? Which means stock has to behave the opposite, which means I will short the stock and I will buy the call. So if I'm buying something, I have negative cash flow for that. If I'm shorting something, I have positive cash flow for that. And hence, in step 2 here, you are seeing that in this, we are taking positive cash flow, but in the case of the option, we are taking a negative cash flow. And the reason behind that is we are shorting the stock and we are going long the call. That is what it means. Yeah. And hence the cash flows are opposite. We are not putting plus on both, but we are putting plus on one and minus on the other. But in both cases, whether the stock is going up or down, can I say value of the portfolio is 15 only? So hence, can I say we have created a risk-free portfolio? Because whatever be the scenario, the price is 15 after the scenario, whether it's an up or down scenario. So future value is guaranteed to be 15. What is the value of that today? So now we discount it back to today. So what is the PV? This is the FV. FV is 15. So what is PV? PV is nothing but 15 divided by 1 plus R. R assumed in this sum is 2% risk-free rate. So hence can I say present value of this risk-free portfolio is 14.71. And now they are asking what is the price of the call option today. So can I say what is the law of one price? Law of one price says that delta times price of stock today minus price of call today should be equal to what? Present value of the risk-free bond today. Yeah. So now we know what is present value of risk-free bond. It's 14.71. We know this. We also know what is delta, the hedge ratio, which was 1/3 we calculated. We know what is price of the stock today. It is at $50 today. So this is 50. I know delta, I know stock, and I can find present value of call today. And that comes out to be 1.96. So this question is asking us what is the present value of call using law of one price or no arbitrage. So this is the third case in which we have applied no arbitrage. The first case was the case where we were trying to find forward interest rates. The second case was when we were trying to find the forward exchange rates. And this case is where we are trying to find the call price today, assuming that we can replicate a call using stock and bond. In this case, we are replicating a bond using stock and call option by investing in delta times or hedge ratio times stock plus call. Any questions on this? So this is how we find the value of the call option. And this whole approach is called as binomial pricing using risk neutral valuation. So we'll end today's session here. Any questions on this? Last
How
thing.
did we get the risk-free rate?
It's given in the problem. 2% input parameter.
Okay, sir.
Yeah. Risk-free rate needs to be known. The strike price needs to be known and the underlying stock price needs to be known. The up move and down move movements also need to be known. Either they will give you the factor. Okay, the D is say 1.2 times. Sorry, U is 1.2 times. So they will give you U, they will give you D, and you'll have to find SU and SD. Okay.
Okay, sir.
So that is how it looks. Also, U into D is equal to 1 in binomial trees. This is a simple case of a one period binomial tree. UD is equal to 1. U is 1.2. So D will be 1 upon 1.2. So you can find UD. So you can find SU and SD. And then you can find the call option up, call option down. And then you can use the same 1, 2, 3, 4 to find the value of the call option today. Yeah. Anything else? Any other questions on this?
No, sir.
Okay. So I will also be giving some practice MCQs. So please practice this. There are around 4 to 5 questions based on whatever we have done. Yeah. So please practice this. Today we have completed reading 2. I took slightly longer because I was also showing it to you on Excel. But we have done the time value of money today, reading 2. Yeah, so next time we'll try to cover 3, 4. Yeah, and we will then go on to do portfolio maths and simulation methods. So we'll be following this reading number sequence itself, and we'll be covering one after the other different readings. So till date, we are done with reading 1 and 2. Yeah. This
I
is where
actually had
we,
a doubt in reading one.
yes.
So what is a cost averaging dollar strategy? I don't understand that. It was used in the harmonic mean section.
Okay. 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 1 second. Let me take out the slides for that. So it's using the harmonic mean concept. Which slide number is that? This one, I think. 12.
Yeah.
This one, right?
Yeah.
Okay. So this is cost averaging. It basically means that we are assuming that we are doing SIP, same investment every period. So your dollar value of the investment is the same. In an SIP, it's like EMI, right? In EMI, you're paying up a loan using EMIs, right? In SIP, when you invest in mutual funds, for instance, you will tell the mutual fund that debit, say, 10,000 every month from my account and make investment of 10,000 every month into the markets. So there it's the same as dollar cost averaging. So here my investment amount is the same every period, same investment amount every period. So in this case, suppose I'm assuming that I invest $1,000, yeah, every period. And suppose the NAV per share were 8, 9, and $10. Now the question is, what is the average NAV price which I'm paying to enter into this? So this is dollar cost averaging. Same cost, rather same investment done, but at different costs, and then find the average cost. That is what it means.
Okay.
Yeah.
Yeah.
So then what we said was that similar to a time, speed, distance concept, here what we are saying is we are investing, say, $1,000 is the investment in period 1, period 2, and period 3 respectively, right? The rates are given 8, 9, and $10, right?
Yeah.
So can I say that to find Okay, these rates will fetch me what? Number of shares, right? Or number of units. So can I say in the first period I get 1000 by 8 units, in the second period I get 1000 by 9, and third period I get 1000 by 10 units. And then what is my average rate? Average rate is nothing but total investment divided by what? Total units. I will continue here below. And total investment is what? 3000? 1000 into 3. And total units are what? The sum of all these three, right? 1000 by 8 plus 1000 by 9 plus 1000 by 10. And that's your harmonic mean concept. So this becomes 3 divided by 1 by 8, 1 by 9, 1 by 10. So it's basically taking the harmonic mean of 8, 9, 10. So in dollar cost averaging, which is like an SIP concept, which means equal investments made in every period, the average rate is nothing but the harmonic mean of the rates in each of the periods.
Okay.
Yeah. Anything else?
No, sir.
And that's similar to your time speed distance concept of harmonic mean. It works the same. Yeah. Same distance you're traveling at different speeds, so the times are different. So average speed is total distance by total time. So we are using the same concept here in dollar cost averaging. Okay. So I shall share everything with you guys. I shall also host it on the LMS, and you all can also look at the LMS which has been shared. Yeah. So thanks so much. We will have the next session soon, probably tomorrow itself, because Tuesday, Wednesday, I'm traveling. So there'll be no sessions on Tuesday, Wednesday. So we'll try to have something tomorrow. Yeah,
Okay, sir.
Okay, sir.
sure. Yash, if you want to talk to me separately, Sarthak, you can log off from this.
Okay, sir. Thank you.
Thank